You know, we're all taught that profit is everything in business. It's the big, shiny number, the sign that you've made it. But what if I told you that's only half the story? And what if focusing on just that one number could actually be steering a business straight into a wall? Well, today, we're pulling back the curtain on the huge difference between looking rich on paper and actually having the cash to survive.
And this isn't just theory. Let's start with a pretty shocking statistic. A study pointed out by High Radius found that a massive 82% of businesses don't fail because they have a bad idea. Nope, they fail because of poor cash flow management. They literally just run out of money, even when their profit and loss statements look perfectly healthy. That's the disconnect we need to get our heads around.
So how is that even possible? Well, imagine two companies. Get this. Both report the exact same net income, a cool $500,000. So on paper, they're twins, right? Equally successful. But under the hood, Company A is scrambling for loans just to pay its bills, while Company B is buying new equipment and growing. This isn't some weird riddle. It's a super common reality, and the answer is all about cash.
And that gets us to our first big point. Profit isn't the king we thought it was. For years, that bottom line was seen as the only thing that mattered. But it's time we understood that it's just one part of a much bigger, more important picture.
Okay, so here's the difference in a nutshell. Think of profit as an accounting opinion. Seriously, it's a score based on a bunch of rules and estimates. But cash flow? That's a fact. It's the actual physical money moving into and out of your bank account. You can't pay your rent or your team with profit. You need cold, hard cash.
The secret ingredient here is really timing. With accounting, when you make a huge sale on, say, December 31st, you send out the invoice, and boom, that money counts as profit for the year. But what if your customer doesn't actually pay you until February? Well, that cash doesn't hit your bank account until the next year. So your profit report says you're rich, but your bank account is empty. See the problem?
So how do we actually get from one number to the other? They're totally connected. You actually start with that net income number. Then you add back any expenses that weren't actual cash, like depreciation. And then, and this is the most important part, you adjust for all those timing differences, like those unpaid customer invoices we just talked about.
So, if profit is just the opening line of the book, the statement of cash flows is the whole story. And it's usually broken down into 3 key chapters, and each one tells you something different about what a company is really up to with its money. The first chapter, Cash from Operations, is the big one. This is the absolute heart of it. It answers one simple question. Does your main business, selling your stuff, actually make real cash? A healthy company is going to have a solid positive number right here every time.
The second chapter is all about investing. This is where you see how a company's betting on its own future. Are they spending cash on new buildings, new technology, or maybe buying up other companies? A negative number here is actually often a great sign. It means they're putting cash to work to grow bigger and stronger down the road.
And the final chapter? Financing. This tells you how the whole operation is being funded. Are they taking out new loans from the bank? Are they selling off parts of the company to investors? Or are they strong enough to be paying down their debt? This section really reveals their financial backbone.
All right, let's go back to our two companies. They both made that same $500,000 in profit. But look at this breakdown. Monsters, Inc. is actually losing $50,000 from its day-to-day business. The only reason it has cash is because it sold off a big asset, a one-time deal. Now look at Gusteau's. It's a cash machine, generating $600,000 from its core business, investing in the future, and paying off its loans. So I ask you, who are you putting your money on? It's a no-brainer.
Okay, now that we know how to read the story, let's talk about how to do a quick health check. Just like a doctor checks your pulse and blood pressure, there are a few key cash flow numbers that tell you almost instantly if a business is in good shape.
We can boil it all down to 3 crucial things. First up, the operating cash flow ratio. This is the ultimate survival check. Can the business pay its immediate bills with the cash it's making? Second, you've got free cash flow. This shows a company's real power. It's the money left over for the fun stuff, like expanding, innovating, or paying back shareholders. And finally, especially for startups, there's the burn multiple. This tells you how efficiently they're turning investors' cash into actual growth.
For that first one, the operating cash flow ratio, there's a magic number to remember, 1.0. If that ratio is anything over 1, it means the company is generating more than enough cash from its main business to cover all its short-term debts. That is a fantastic sign of a stable, healthy company.
But what if a company's trying to pull a fast one? Now, it's a lot harder to fudge the numbers on a cash flow statement than an income statement, but harder doesn't mean impossible. So let's look at a few of the red flags you gotta watch out for.
So here's your detective checklist. If you see operating cash going up while sales are flat, you have to ask, where's that cash really coming from? Another one, if a company suddenly starts moving costs from the operating bucket to the investing bucket, they might just be trying to make their core business look healthier than it is. And a big one is if they're always selling their invoices to get cash early. That's kind of like taking out a payday loan on your own sales. It's not sustainable.
All right, this all leads to the most important mental shift of all, learning to think in cash. When you do this, it completely changes how you make big decisions. It's not just about tracking numbers anymore. It's about timing your moves for maximum impact and, frankly, minimum risk.
So let me throw a bit of a paradox at you, based on a real company called Setpoint Systems. When do you think is the best time to make a huge purchase, like new equipment? Logically, you'd say it's during your most profitable quarter, right? I mean, that's when you're making the most money. Well, what if I told you that's actually the worst possible time?
The numbers here are just wild. In quarter one, Setpoint's profits are through the roof, but their actual cash in the bank, it's at rock bottom. Why? Because they've spent all their cash on supplies and labor to get those big orders out the door, but the customers haven't paid them yet. Then, look at quarter two. Profits look lower on paper, but their bank account is overflowing because all the cash from Q1 sales finally landed.
And that is the huge strategic lesson here. The absolute best time for them to buy that new equipment was in quarter two, when they were flush with cash, even though the profit report didn't look as good. This is what it means to think in cash. You line up your big moves with when you actually have the money, not just when the spreadsheet says you're profitable.
In the end, it really comes down to this great quote from Code Signal. Cash flow statements expose the true priorities of senior management. You can forget the mission statement hanging in the lobby. If you want to know what a company's leadership truly cares about, whether it's wild growth, steady stability, or battening down the hatches, just follow the money. The cash flow statement tells no lies.
And that kind of leaves us with one final thought to chew on. Whether you're an investor, an employee, or you're running your own show, the real story is in the cash flow. Profit tells you if you won last quarter's game. But cash flow? That tells you if you can even afford to stay on the field for the next one. So what story is your company's cash flow telling?